afternoon. Welcome to this special show on the monetary policy. I'm Lata Venkatesh. The Reserve Bank didn't cut rates as expected, but it shut the door on hopes of a cut in the next policy by forecasting the one-year ahead inflation, that is April-June 2026 CPI, at a huge 4.9%. So if rates are to be fixed looking at the year-ahead CPI, there is no scope for a cut, Reserve Bank seem to be saying, because inflation is going to be much above the mandated 4%. Equally, the Reserve Bank seemed to say poor growth isn't an excuse to cut rates. It retained the current year's GDP forecast at 6.5%. When I prodded the governor about the tariff impact, the governor said Reserve Bank brought down the growth forecast from 6.7 to 6.5% in the previous June policy, primarily to account for the global impulses. So, clearly, no further cut in GDP. This led to the yields in the market rising. However, I just want to leave my personal impression from the press conference. My impression was that the governor on 3 separate occasions in the conference said that the RBI will monitor the macros on a policy-to-policy basis. That was his quote. The MPC will take a view meeting to meeting, he said in response to another question. And then he said the MPC meets every 2 months and will consider all scenarios. 3 times. So this gives me the feeling that we can't rule out a cut maybe in December or February next. But with that initial impressions, let me invite the experts joining me to parse the policy. I'm Mridul Sagar, former MPC member, former RBI ED, and now Professor of Economics at IIM Kozhikode. Samiran Chakrabarti, the economist from City India, and Abhishek Upadhyay of ISEC PD. Well, gentlemen, thank you very much for your time. In a bit, we're going to be joined by the State Bank of India chairman as well. But Samiran, let me start with you. You wouldn't say that this repeated reference to we will change policy to policy, meeting to meeting, does give a hope somewhere in maybe February or December, especially if the Fed were to cut rates several times? No? You don't think there's a hope?
Lata, our baseline assumption is that RBI has gone for a longish hold now. Part of the reason why RBI probably decided not to cut 25 basis points today was precisely this reason, that they would have otherwise felt the pressure to hike sometime next year when inflation numbers would inch up. So they've given that buffer to themselves of not being forced to hike next year. In our view, out of the 2 things of downside surprises to growth versus downside surprises to inflation, it is more likely that the downside surprises to growth could cause a change to this view and force RBI to cut rates further. For that, we'll have to wait for some more time to get clarity on to what extent the tariffs, etc., are reducing RBI's growth expectations. But inflation numbers, where the projections stand today, it is very unlikely that small changes to inflation forecast would make material differences to RBI's rate path. Having said that, we are very conscious that early next calendar year, we are going to see base year revisions to both GDP and CPI. So to what extent those series deviate from the current series on the basis of which we are forecasting could also have material impact on policy decisions.
Fair point. That, of course, is a googly. And the governor clearly said that he has not taken into account any potential changes in the CPI index itself. Mridul Sagar, you've been there, done that. Did you get the sense in the press conference, if you heard every word of it, that this was the Reserve Bank's way of, changing its tone once fresh data comes, maybe in December?
I can't completely rule out a December or a January change, but from what it appeared today, and in fact, even from the last policy, it looked RBI is on a baseline basis there for an extended pause. Now, if today's policy has given an impression that it is a hawkish pause, I would completely disagree with that. I think it's a realistic pause. and naturally the neutral stance has to be retained. And also because front loading of the rate cuts had been done, there is very little scope now for further cuts. If the only reason why a rate cut hope, many people are saying, has come from a 60 basis point reduction in the inflation projection for the full year, we also have to be cautious that basically what we are seeing is an increased uncertainty around that baseline projection. If you the fan chart in the monetary policy resolutions, basically there is a 20 basis point hike on the upper side of the inflation expectations. So we can't completely rule that out. And there is lingering tariff issue, which is there at the back of the whole considerations. So if tariffs, if India doesn't join the tariff war, I think that's one good thing that can happen, because retaliatory tariff will only complicate the monetary policy autonomy even further. So we just have to keep our cool and ensure a macroeconomic stability at this juncture. What is important is that the saving investment gap should not be widened. And that is the macro identity with the current account deficit. So if we start cutting the rates at this juncture, the financial saving rate, which is already hovering around 5% of the GDP, which is very low, could take a further hit.
Actually, that's a very important point. And I mean, we don't discuss this often, even in the Reserve Bank press conference. You would think that's a big reason, right? In any case, household financial savings are not where we would like them to be. And that would be one reason why the Reserve Bank is wary of cutting, right, Mridul?
Yes, absolutely. If you see where the neutral rate is with the inflation projections we have, the neutral rate is at best 1.1% if you take the Q4 inflation projection, and has gone below 1 at 0.85%, the policy real rate, in case you have the first quarter.
The June policy,
The June policy. And also mindful that the weighted average term deposit rate in real terms has fallen dramatically now, and that could really affect the saving behavior in particular terms, with foreign banks in particular almost into the negative terrain on the real rate basis of the deposits.
Okay. No, I'm glad we don't get the saver's point of view. We are always worried about those who pay EMIs, and this is something which lately the Reserve Bank, as the monetary authority, should worry about. Abhishek Upadhyay, you know, the 10-year yield went to 6.4, yaar. I mean, that was quite a reaction. What is the market and the swap market telling us? They are ruling out rate cuts altogether?
Well, Lata, so the bond market reaction clearly indicates there was some expectation RBI could move in the next policy, if not in this policy. And because there was no clear guidance that is going to happen, we have seen some reaction. If looking at the swap markets, there was about a 60% probability, we estimate, for a rate cut in October, which was priced heading into this policy meeting. After the market moves today, this probability could potentially be 25-30%. So a probability of October cut has gone down from market pricing standpoint, and which is logical. At the same time, we don't have any view of more rate cuts from RBI, but I agree with other panelists that the bias has to be towards the risk of more easing from RBI down the line, even if those actions are delayed. And that view in turn mainly stems from RBI likely now adopting a more reactive approach to realization of any downside risk to growth rather than a preemptive approach they have followed so far. And there are downside risks to growth projections which RBI has put out. Just that there is still uncertainty about whether there will be any response on the fiscal policy front, for instance, to manage the fallout of tariffs, as also the impact of monetary policy transmission on growth, which would be seen in the second half of the year. RBI is likely waiting for clarity on those parameters before taking another basically step.
Fair point. Actually, Sabiran, when will we start seeing signs of growth not quite making it to 6.5? the August 31st number will be for April, May, June, and that may well be 6.5. There is a base advantage. As well, we've seen fairly strong rural demand. You can see it in the two-wheelers and a few other, the PMI looks strong. Even when you go to the December policy, you're only going to have on November 30th, the second quarter numbers. That also has a very strong base effect. It was, 5.4 a year ago. So do you think even by December, there will be enough signs of slowing growth?
Unlikely on the GDP print, because apart from the base that you were mentioning, the first half GDP is going to significantly, the real GDP is significantly going to benefit from a very favorable deflator. Both CPI and WPI numbers have been extremely low. And because we are unable to do the double deflator method in GDP calculation, there is a possibility that the real GDP growth numbers might look better. But I'm guessing that there are now so many high frequency growth indicators that we track that if the tariff related effects are going to be there on the economy, then some of these high frequency indicators will start picking that up even before the GDP data. So to that extent, I think by December, we will have some clarity on whether the RBI will need to revise down its 6.5% GDP growth forecast for the full year or not.
Okay, yeah, we would have other signs. Would you agree, Mridul, that, RBI would have its own heat map, right? And if the tariffs get ossified at 25%, it looks like we are going to be lucky if it's 25, going by recent comments. Do you think that we will start seeing the pinch in lead indicators much earlier?
It is possible, not so much with the direct crunching of the numbers, but the sort of confidence channel which will work in this case and can lead to some capital outflows is the worry I have about the growth numbers. But also remains the fact that it will also push inflation up if India also sorts of get into a retaliatory tariff argument. And we have basically import share of the goods at nearly 36.4% in the CPI, which is not insignificant, even though it's not as high as in WPI.
Mridul, I think India will not shoot itself in the leg. I don't think they will.
Absolutely.
Certainly, they are not going to. The posturing will not go to the extent of hurting ourselves.
I agree. I mean,
the statement that came out was pretty measured, a very measured rebuke. So, okay, let me actually get your growth forecasts, all of you. I didn't get a single person at 6.5 when I took a poll. So, the maximum I got was 6.3. But in any case, what are your forecasts, Abhishek, for the current year?
6.3 with 30 to 40 basis downside if tariffs stick.
Okay. Samiran?
We are at 6.7 with 0.2 to 0.4% downside risk from tariffs, which we have just put it as a sensitivity analysis rather than putting it in the baseline.
So you're, barring the tariffs, you're expecting it to be even better than what the Reserve Bank is saying, 6.7.
Absolutely, because of two reasons. One I mentioned is the deflator effect, which will positively impact the first half. And second half, we think that without tariff, or if the tariff gets resolved in some way, then I think market is underappreciating the stimulative effect of both the monetary and fiscal stimulus that has been given. So we have built in a slightly better growth forecast than what the street is probably thinking.
Okay. I know much of that depends on how the market performs. India is becoming a stock market-led country, and if the wealth effect evaporates for whatever reason, then stimuli may not help, is my feeling. Where do you stand, Mridul, in terms of growth? Do you make these forecasts?
So I do make, but I'm this time largely in line with the RBI focus, because I do see some tariff effects coming basically through the confidence channel and the capital outflow channel, which might accentuate, given that the pricing markets is very high at the moment. So some correction could come in, and that would have its own repercussions for the growth, as you rightly pointed out, that there are wealth effects on the consumption and also on the investment, basically, of the collateral valuations go down. So that might push India back to 6.5. And 6.5 is essentially because what Samiran was pointing out was the deflator issue. So your WPI inflation is very low at the moment, but with tariffs, the WPIs would get affected probably more than the CPIs. So that could start getting corrected as we go down the line. So we have to wait and watch the forward-looking numbers closely.
Fair point. Okay, so not all that negative, the two of you, primarily because, we have got the inflation number is not likely to be very high. Abhishek, very quickly, I wanted to know what you made. Was there any hint on how liquidity would pan out? Do you continue to see the call rate being lower than the repo rate?
Lata, RBI has come out with the liquidity management framework report just a few minutes back. So we see no big changes there. Some of the changes, which markets was somewhat worried about, including a potential shift in monetary policy benchmarking to a secured benchmark from weighted average call rate, which is the benchmark currently. That would have meant that RBI would have needed to tighten liquidity conditions potentially and or provide the non-bank participants access to SDF window. That has not happened, so WACR remains the overnight target. Other changes include shift from a 14-day financing operation to a 7-day operation, but that is not significant. RBI is already conducting operations that ways. There has been no provision of liquidity provided at the fixed rate repo window, which some, including us, would have hoped for, even if RBI could have capped that provision. That has not happened. But to your question, what this means is that because RBI will not be conducting, fixed rate repo operations or overnight operations as the main operation, overnight rates will either be somewhat lower than repo rate or higher than repo rate, depending on the liquidity conditions. Based on the liquidity outlook that we have for next few months, when CRR cuts also will kick in, we think WACR, weighted average call rate, will be somewhat below repo rate in the next few months, but closer to repo rate rather than the SDF rate.
Okay. Well, Samiran, do you want to add to that? Actually, running out of time, I do want your view on the rupee as well, with what the Reserve Bank is saying, with the way non-farm payroll numbers have come. Does the rupee look like crossing 88 to the dollar?
Well, it seems like the RBI has allowed a bit of depreciation in the real effective exchange rate. Also, we are now tracking the RER somewhere around the 99 to 100 range, which is slightly lower than the historical range on the 40-country RER. And this could be RBI's way of thinking that this is growth supportive, or it could be because RBI wants to create a bit of buffer on the tariff by keeping the exchange rate in an offset mode. So the primary way to approach the currency, if RBI believes that the currency is depreciating more than what it wants, is through FX intervention, not through the interest rate channel. So from that perspective, I would think that whether RBI considers any further rate cut or not, that will be more determined by the growth outturn rather than the exchange rate.
Oh, absolutely. I think that has been long the Reserve Bank's policy, and it's only under very disturbing conditions that they allow the global factors to impinge on them. Unfortunately, out of time, but thank you very much, Samiran, Mridul and Abhishek, for joining me. We have to take a break, and after that, we will have the biggest banker joining us, SBI Chairman C.S. Setty, on what he has made of the policy and how he sees the economy evolving from here on. Back in a jiffy. Welcome back to our special show on the Reserve Bank of India monetary policy. We now have with us the country's biggest banker, State Bank of India Chairman, Mr. C.S. Setty. Thank you very much, Mr. Setty, for joining us. What is your key takeaway from the policy?
Key takeaway essentially is that, I think in my view, the pause is justified. The transmission is work in progress now. The 100 basis point affronting the rate cut last MPC is, I think it needs to be fully digested by the system.
Okay.
From that angle, yes, I think it's a very positive
The
one.
pause is justified. Okay, but the pause is also welcome, I guess, from a banker's point of view. I know that you are tongue-tied now because of the upcoming results. But for the sector as a whole, do you think that Q2 will be the lowest in terms of margins now that chances of a rate cut are not there?
Well, I think the transmission is happening. I think the levels of transmission, as Governor mentioned, is different in the sense that the deposit rate cuts seem to be moving faster for the industry than the loan rate cuts. But this was the trend which we have seen when rates have gone up also.
Yeah.
The rate cuts on the credit side, essentially, because the whole book is not EBLR.
Yes.
The book, MCLR book also, it takes some time to get repriced. That is a difference which we are seeing, but otherwise, I think transmission is definitely happening.
No, transmission is happening, but would you say that, see, all banks reported between 5 and 35 basis points of reduction in margins in the earnings season that's underway. Do you think we will see more cuts in the current quarter, that is the July, August, September quarter, but that will be the worst? You will start seeing improvement in margins from Q3 for the sector?
There will be some calibration on the MCLR side because, as I mentioned, there's a lag. Some of the rate cuts which are affected in deposits the last month are, that get impacted in the current month, which means that in this quarter also you may see some readjustment of MCLR by many banks.
Okay. But you expect margins can improve by the next quarter?
Yeah, I think I did mention Lata last time also that the NIM trajectory would be U-shaped and most of the NIMs probably will come back to the normal level at the end of the financial year.
By the end of the financial year. Okay, I wanted to move, the worry is more about credit growth actually. For the system, it is in still single digits, not yet reached 10%. Do you think that, are you seeing enough impulses in terms of a double-digit credit growth for the system? Not for SBS, sir, for the system.
For the system, generally Q1 is a lighter quarter, but the base impact, the last year, the 24-25 credit growth was robust. That's the reason I think the percentages looks lower. But generally, I think we all are expecting that Q2 may have some positive impact, but not very noticeable one.
Okay.
And the second half, Q3 and Q4, generally are good quarters. And hopefully, I think the system will have a better credit growth going forward.
Okay. I'll tell you, the big borrower, that is corporates, are now actually seriously deleveraged. And it's not as if we've got too many capex plans. If you look at the CMI numbers, it's more a government capex, private capex is not roaring. As well, they have enough money. Internal retained profit. The retail sector as well, you don't go and buy a house simply because rates are cheaper. The way in which TCS announces job cuts, the confidence channel is not really shining bright. So do you think that in spite of the fall in cost of money, the extent of loans may not grow very fast?
Housing is a different ball game altogether. I think a lot of investment decisions are made, obviously, taking several factors into account. One is, as you mentioned, of course, the confidence of continuing in the job is a very important one. But the large unmet demand for housing is always there. So that has resulted, even if you see, while it is a rate-sensitive sector, mortgages, always, long-term mortgages, people do upfront their investment decision if the interest rates are lower, but they also know that it depends on the affordability and the need for housing, and all these things come into picture. Last time around, when the rates were higher, even then we have seen a robust housing loan credit growth, which means that the housing loan market I mean, seem to be decoupling from the interest rates.
That's my point, sir. If housing loan is not taking cues from the rate cut and corporates are not taking cues from the rate cut, necessarily will rate cut mean a very good credit growth?
Let me finish on the housing and then I'll...
Sorry.
So I think what I'm trying to say that while last time around, even higher rates of interest propelled people to buy houses, the need for housing is definitely there. And coupled by the fact that interest rates are softening, it would definitely improve the housing loan growth rate. And as Governor mentioned in the presser, 14% industry average growth rate is not a small one in housing. I think it's a very robust and it's a very large base of housing loan segment now. So 14%, I believe, is a very good growth rate. We need not really worry about housing. And the corporate, yes, I think there are several factors influencing corporate credit, particularly in terms of the movement from the bank credit to the markets. Obviously has happened, not necessarily that the CP/NCD market, the participants are banks. In fact, I feel that less participation with the bank in CP/NCD because the rates are historically low now. It's mutual funds, insurance companies which are participating, which I believe we should all welcome, right? When the households are moving there, they should participate in the debt market. I think we should not really worry about it. What we need to really be concerned is that the private capital investment is not broad-based. We are seeing that it is primarily coming from the renewables, roads, or maybe some data centers. We still are yet to see what is happening on the core sectors, cement and all. I think it's industry-wide. The combination of not taking the investment decisions at this moment, and also the fact that they all are having adequate cash balances. So that is also is one of the reasons why we don't see corporate credit happening as much.
Okay, so we will continue this conversation when your results come out and you are in a more cool position to speak about the future. Thank you very much indeed for joining us. That's the State Bank of India chairman. From a banker's point of view, the margin cuts perhaps end with this quarter, and you may see improvement in margins from Q3 onwards, and definitely improvement in Q4 because further rate cuts are not there. But on credit growth, there are still some question marks. And on growth itself, if the global confidence and the global uncertainty doesn't change. With that, we wrap up on this show. Thank you very much for watching.